Okay, we're going to finish chapter 12 by talking about projects, and in particular, how do we assess the cost of financing for individual projects within the company. So one of the ways we can do this is look at what we refer to as all equity comparables. We need to find an all equity company that is very comparable to our project. Using that company's equity beta, then we can forecast the actual cost of capital for this company, since they're similar. And of course, you realize that there are very few, if very few, all equity companies. So what do we need to do? We really need to then have a way to look at levered firms as comparables. So we're going to start with the all equity concept and then add the debt factor. And again, using a comparable project, right? This company has debt and equity. We want to use a project very similar in the asset base. Assume the debt and equity remains the same. It'll give us an idea here of why we're trying to show the cost of financing for this comparable firm can be used then to look at our particular project. So again, we're looking at this company. We're going to do a business plan, right? We look at this financial plan. We estimate that the cost of capital of the opportunity is 3%. And the market risk premium is 5%. So what we do is we look at this company, Pete's Coffee, and we find that they have no debt, and that their beta is 0.83. So this is a beta that represents a company that has no debt financing. So if we look at the cost of financing for this project, and use the beta of Pete as the risk factor, we see that the cost of financing for this particular project should roughly be 7.15%. So again, since this company has no debt, its beta represents a non-debt company. So what do we do then when we start thinking about debt, right? The R sub U here is the weighted average cost of capital for the company. And here we have the weights of equity multiplied by the cost of equity. We have the weight of debt times the cost of debt. That's going to give us this R sub U, or the cost of financing for this company. Solving for beta then, the beta of the company, again, is the weight of equity times the beta of equity, plus the weight of debt times the beta of debt. Seems pretty similar. We're just kind of moving along, except now we're talking about this other company. So we're looking at expanding our projects. Procter & Gamble, their equity has a market capitalization of $144 billion, has a beta of 0.57. They also have $37 billion of AA rated debt, and the average yield of their debt is 3.1%. So what is the cost of capital of this firm's investment in it if the risk-free rate's 3 and the market risk premium is 5? Well, R sub U. Right, so we have, here's the amount of debt in the equity in the company, and here's their cost of equity. 3% times their beta times the 5% market risk premium. It's 5.85%. Here's the weight of debt. 3.1% is the cost they have. So the ultimate cost that we have here is 5.29%. Done another way, we can calculate what should be the beta of our company. Here's the proportion of equity times its beta. Here's the proportion of debt times the beta of debt for a AA rated company. So we end up with a beta for this company of 0.453. Again, plugging that into the CAPM model, we see we end up with 5.27. And of course, they're very, very close. So again, we have this assumption, obviously here, that the cost is going to be very similar to those items, if you will, or that range. Plugging into we have an asset beta worksheet. You can plug the information here. Here's the beta of here's the beta of P&G. Here are their equity numbers. So the pure play equity should be 0.453. When you plug that 0.453, we know what is the relationship, right? 0.453 down here. We end up with we just plugged in here, 0.45 goes down below here. 3% is the risk-free. Here's the market risk premium, and that's where we came up with the 5.267%. So again, we have a format in which we can determine what the cost should be. Now, what happens, just to kind of jump the gun a little bit, since we're looking at the spreadsheet, what happens if we finance differently? The ultimate conclusion of this is this should be the pure play equity beta of P&G. What happens though if we change, if we have a different relationship in debt? What we want to do is input our debt equity mix here so that we will end up with a project beta. That number would then be plugged in down here. As you see here, all I wanted to do was confirm the previous slide there, that is the ultimate cost of equity or cost of capital for this project. Some firms have lots of cash. Cash is risk-free. So it obviously reduces the average risk of a company's assets. So since the risk is what we're concerned with, the leverage we use should be measured in terms of net debt. So the debt number that you use in our calculations should be debt minus the excess cash and short-term investments. So again, here we have a capitalization of $21 billion. $8 billion in debt, $13 billion in cash. If the estimated beta is 1.41, we need to estimate the beta of the underlying business. So the net debt, 8 minus 13, is actually -5. So we plug that in here. Here's the weight of debt, 21, divided by 21 minus 5, multiplied by their beta of 1.41. Again, we're assuming a debt-free basis here. And then here's the weight of debt times 0. So the equity here, the beta, should be 1.85. So the Dell's equity is less risky than its underlying business activities. The beta is less because in the end we also have this cash element that we can attribute to the company itself. So now we can combine these things. We could use some industry data possibly to help us calculate this cost. Here are some companies that are all in the same industry. Here are their equity betas. Here's their debt value ratios, the debt equity ratios, and here are their debt ratings. So what we can do is we can average these. What is the average asset beta? Well, here is the equity beta. There's their debt rating. There is the debt beta that we talked about a little bit earlier, that we know that debt has some ratio. So their asset beta is calculated with this ratio. So for the very first one here, it's the amount of debt. It's 1 minus 0.59 times the equity beta multiplied by 0.59 times the debt beta. So the asset beta for DDS, which is Dillard's, is 1.13. We do that for all of the companies and we get an average. So the average is about 1.16. Now we could use that as the beta for our company, or for our project. And what you can see is that when you talk about different industries, most industries, the range of asset betas is fairly close. There are some industries where there's a pretty wide discrepancy. Can look at this is the third one. It's automotive manufacturers, pretty big range there. This looks like education service, pretty big. But for the most part, most of these industries, the range of asset betas within the industry itself is not that wide of a range. So what I did is I did this obviously for quarters. I found their competitors. I found out what those companies' betas were. We then also identified the debt equity ratios, and then from that calculated the asset beta. So you have the asset beta averaged out to be 0.657. In the end, we revised that company equity beta to 0.849. So the risk-free rate was 3.6. The market risk premium that we got for some EBITs and beta was 8.1. So in the end, the cost of equity is 10.54%. What about talking about projects now that have different levels of risk? Asset betas represent market risk. Individual projects, though, may be more or less sensitive to the market risk. They may have different amounts of internal risk, different from what the company itself is. Again, if you think about a company like 3M, has lots of different industries. And I think this is very relative for almost any company you can think of. They don't just work in one specific industry. So we need to evaluate projects based on the betas of companies that are similar. So again, moving on and just trying to add to some of the complication here. Another factor then that ultimately affects the market risk of a project is the operating leverage. And I think that really adds to what we were talking here. Excuse me, I went the wrong way. Right? We have healthcare, computer display, and graphics divisions. How you run those kinds of divisions is very different. Healthcare, the operating leverage, the amount of fixed costs in running the healthcare industry is a lot different than manufacturing. So this operating leverage is going to have an impact on the beta of the company. Higher proportions of fixed costs will increase betas. So there should be a higher cost of capital assigned to those kinds of projects. So how might the project's cost of capital change when we start talking about using leverage to finance the project? In perfect markets, it doesn't matter. The choice of financing doesn't affect the cost of capital or project net present value. The challenge is we don't live in a perfect market, and taxes are important. So now what we're going to do is take the concept we had before. We had these formulas to calculate the cost of capital and or the beta of a project using comparable kinds of industries. Now we're going to say, well, what happens when you add taxes? When you add taxes, the weighted average cost of capital, the debt factor is influenced by taxes since debt is tax deductible. So if you have a target leverage ratio, if you have a target amount of debt that you want, you take the R sub U, right, the formula from before, that weighted equity not taking into account taxes, and then you subtract from it the relative cost of debt. Here's the amount of debt we have. here's the before tax cost of debt, and you multiply that by the tax. So this represents, in some sense, the tax impact of financing. It reduces the cost of financing the company itself. So, again, how do they compare? Well, obviously, the R sub U is greater than WACC. WACC in a world with taxes is less, and that's the number you should use since we obviously live in a world with taxes. And I understand this is a fairly complicated process, but really in the end it's very simple. You estimate the cost of using the different aspects of financing, and you just apply them to the cost or the weights or the proportions of debt in the company. So here we have an example of what we did with cores. There's a MBA WACC weighted average cost of capital worksheet, and here you can input here I just used the 5 longest maturity issues. For cores at this time there were only 3, and I found the market value of those. Find out how many outstanding bonds there are, what's the cost, what's the yield to maturity, and then I just found the weight. You find the market values, you find the weights. So the average yield to maturity was 3.51, but the weighted average ended up being 4.11%. So 4.11 is the cost of debt that we're ultimately going to use for cores. We calculated, again, here's where we calculated the cost of equity. So over here we have this, the after-tax cost. We have to adjust the 4.11 by the tax rate. So the after-tax cost is 3.04%. The company has $4,650 worth of debt. They have 93.45 is their that's total debt. 93.45 is their equity. So it's essentially 2/3, 1/3 as far as the weighting scheme. So then we plug in the their tax rate is actually 26%, not 40%. So the weighted average cost of capital nets out to be 8.049%. I mean, how does that pan out to what you actually find from some websites? Because we can't actually go to a website. There's one called That's WACC that gives us a picture and, quite frankly, a number that we can adjust to calculate the overall cost of financing for the company. So again, there's a lot of assumptions on this. The idea of estimating cost of capital. How reliable are the results? Well, that's part of the issue. Sometimes the results are not all that reliable. The types of approximation are really no different. So there are going to be errors made. CAPM is practical and easy to implement. It does give us a little bit of a disciplined approach. It gives us a methodology to follow. And quite frankly, in the end, CAPM requires managers to think about risk in the right way. So again, our overall view, if you will, is that utilizing the capital asset pricing model to determine the cost of financing for projects inside the company appears to be the right way to do it.